The most dangerous thing about this market is not that it looks fragile. It is that it still has not broken. That is where I want to begin. Because most people look at a market that keeps rising and assume the rise itself is evidence of health. They think survival is proof. They think persistence is strength. They think that if a correction has not arrived yet, then perhaps the pessimists were too early, too dramatic, or simply wrong. I have never trusted that kind of comfort. A weak bridge does not collapse the moment the first crack appears. It collapses when enough people have grown accustomed to crossing it. That distinction matters in markets more than almost anything else. By the time the public finally agrees that the structure is dangerous, the structure has often been dangerous for much longer than the headlines were willing to admit. So when I look at the stock market today, I do not ask the childish question most people ask. I do not ask, why has it not crashed yet? I ask what is still holding it up. And I ask a second question that matters even more. What happens when those supports stop working all at once? That is the real issue. The contradiction is obvious if you are willing to stare at it without taking comfort from the tape. Consumers are stretched. Debt burdens are high. Real purchasing power has been chewed down by inflation. Hiring is cooling. Layoffs are no longer isolated curiosities. Valuations are living in territory that in earlier eras would have made investors visibly nervous. And yet the market continues to behave as if none of this belongs to the same reality. That sort of contradiction does not calm me. It makes me more attentive, because the market is not a moral machine. It does not hand out punishment the moment conditions become unreasonable. It can delay, it can flatter, it can continue much longer than frightened people expect. But the delay itself carries a cost. Delay allows excess to deepen. Delay allows leverage to rise. Delay allows fragile confidence to get mistaken for durable strength. That is why I think the delay is the danger. If I strip the market down to its valuation core, the message is already loud enough. One of the measures I have respected for a long time compares the total market value of public companies with the output of the real economy. People now call it the Buffett indicator. The label does not matter. The arithmetic does. If public companies are worth roughly $66 trillion, while the economy that is supposed to support them produces about $30 trillion, then the ratio is around 220%. That is not ordinary. For a very long time, anything much above 100% would have been enough to raise eyebrows before the dot-com collapse. The ratio was around 115%. That alone was considered stretched. Today, the number is dramatically more extreme, and many people treat that as if it were merely a new normal. I do not. An extreme valuation is not a precise timing device. It does not tell me the exact week a break begins. It does tell me the market is floating in a zone where price and productive output are no longer in a healthy relationship. That matters because eventually markets are forced to remember what they are sitting on top of. The S&P 500 tells the same story in a different language. Historically, broad American equities have often traded around 15 or 16 times earnings. Those numbers move over time. They can stretch during optimism. They can compress in fear. But when broad valuations climb into the high 20s while the most important companies are far above that, I stop listening to easy narratives. I start listening to arithmetic. NVIDIA has traded above 50 times earnings. Amazon has lived in the 30s. Microsoft has traded in the mid to high 30s. Tesla has occupied valuation territory so extreme that the number itself stopped being a normal analytical tool and became more like a warning label. When investors pay $30, $40, or $50 for each dollar of present earnings, they are not buying certainty. They are paying today's money for a version of tomorrow that has to go almost perfectly. That is a fragile arrangement. So why has it not cracked? That is the central question. I see two major support beams carrying most of the visible weight, with several smaller beams helping confidence stay upright. The first is disguised stimulus. The second is the combination of inflation and a weaker dollar. Most people think stimulus ends when the obvious checks stop. I do not think that way. Governments do not need to slap a giant label on support for support to remain active. They can continue spending at levels far above what current revenues justify and let the liquidity move through the system in quieter ways. If the government collects about $5 trillion and spends closer to $7 trillion, that is not an academic gap. It is a real force moving through contracts, subsidies, tax treatment, payrolls, infrastructure, transfer channels, and a general persistence of demand that would otherwise be weaker. That matters because spending props up earnings. If large deficits keep feeding the bloodstream of the economy, then corporate revenue does not need to come from healthy organic demand alone. Consumers keep buying longer than they should. Businesses keep reporting sales that look sturdier than the balance sheets beneath those sales. Investors keep saying words like resilient and strong while confusing fiscal life support with genuine durability. And the public loves that confusion. It wants to believe the system is stronger than feared. I think it is more accurate to say the system is being helped more aggressively than admitted. That support is not free. The United States is carrying about $38 trillion in debt. Annual interest costs now run above $1 trillion. A government can use debt to buy time, but it cannot buy time without also increasing the future burden of having bought it. This is why I do not treat large continuing deficits as proof that everything is manageable. I treat them as evidence that the bridge is being held up by expensive beams. The second support beam is inflation and dollar weakness working together. This part confuses people because they experience inflation personally and miss what it does to markets mechanically. The average household thinks of inflation as higher grocery bills, higher rent, higher insurance, and the miserable feeling that the paycheck shrinks while the price tags grow. That is true as far as it goes. What many investors forget is that inflation also changes how nominal earnings look. If the dollar weakens and money remains abundant, nominal prices rise. That includes the prices of goods and services, but it also includes nominal revenue and nominal profit. Companies can report bigger numbers even if their real underlying strength has not improved very much. The numbers look like growth. Sometimes they are only inflation disguised as growth. Wall Street understands that better than the public. If inflation stays stubborn and the dollar remains weak, companies can continue reporting figures that are good enough to support inflated valuations. Investors then say, look, earnings are holding up. What they often fail to say is that the measuring stick itself is deteriorating. A weaker measuring stick flatters the score. This matters because it helps explain why the market can stay disconnected from economic pain longer than seems reasonable. If nominal earnings still look good enough, then valuations can be defended by people who do not want to examine how much of the appearance is real and how much is monetary distortion. There is a darker layer here as well. Inflation tends to help those who borrowed cheaply to buy assets. If you borrowed when money was easy and used that borrowed money to acquire stocks, businesses, or real estate, inflation can work in your favor in two directions. The debt becomes easier to repay in real terms because the dollars used for repayment are weaker. Meanwhile, the assets may appreciate nominally or throw off cash flows that rise with the broader price level. That is not a conspiracy theory. That is the machine. This is why I say inflation is selective. It hurts nearly everyone emotionally. It does not hurt every class economically in the same way. The ordinary household feels inflation first as a loss of purchasing power. The heavily asset asset-backed owner often feels inflation through asset support, nominal growth, and the gradual erosion of old debt burdens. The poor and middle classes feel groceries. The rich often feel balance, sheet support. That difference helps keep the market suspended longer than many people expect. Now, none of this means the market is healthy. It means the market is being carried by forces that can keep confidence alive, even while the underlying structure grows more dangerous. That distinction is essential. A sedated patient is not the same thing as a healthy patient. A propped-up market is not the same thing as a strong market. Then we arrive at the consumer. American output still leans heavily on consumer spending. As long as people continue buying, the market can keep pretending the sickness underneath is manageable. The public sees continued spending and assumes vitality. I see continued spending and ask what balance sheet is paying for it. Those are very different ways of reading the same fact. If consumers are spending out of rising real strength, that is one story. If they are spending while savings are thin and revolving debt is large, that is another story entirely. One is durable demand. The other is borrowed delay. This is why consumer debt matters so much in the current structure. The spending is still there, but increasingly it does not look like the spending of a financially healthy public. It looks like spending supported by credit, by hope, by habits that have not yet adjusted to new cost of living, and by the social refusal to admit that the old standard of life has become more difficult to finance honestly. That kind of spending can keep earnings alive for a while. It cannot be trusted forever. Then we come to the labor market. People still talk about employment as if it remains a fortress. I think that language is too generous. Hiring has slowed. Layoffs are appearing in more places. Yet employment is a lagging variable. That means it often looks stronger than it really is right before deterioration becomes obvious. A labor market can be late before it is strong. That is one of the most misleading conditions in a late cycle. People see jobs still existing and assume the machine must be fine. What they may really be seeing is delay. The layoffs have started, but the full acknowledgement has not. And then there is the old reflex everyone wants to believe in. Policy rescue markets learned a comforting script in earlier cycles. Trouble appears. The central bank cuts rates. Liquidity returns. Prices stabilize. Investors have been trained to trust that reflex. I understand why. It worked often enough to become a habit in the mind. I am not convinced this cycle is built on the same foundation. Consumers are already stretched. Debt is already heavy. The cost of living has already damaged confidence. Lower rates may help at the margin, but they may not repair the deeper issue, which is that too much of the visible strength rests on borrowed endurance rather than durable financial capacity. This brings us to the most important cycle inside the whole market story. First, valuations become unreasonable. Then bad news stops mattering for a while. Then people begin to mistake numbness for strength. And then, eventually, one event arrives in an environment where confidence is no longer elastic enough to absorb it. That is when the break comes. The trigger is not always the thing people predicted in advance. It is not always the biggest event in a dramatic sense. Sometimes it is a bankruptcy. Sometimes it is a credit fracture. Sometimes it is a policy error. Sometimes it is a large company disappointing at exactly the wrong moment. Sometimes it is a failure in a place everyone had lazily decided was safe. The trigger is less important than the context. A market that is already stretched, already numb, and already leaning on temporary supports does not need a theatrical reason to fall. It only needs something strong enough to reveal that confidence was the final load. Bearing beam, that is why the bridge metaphor matters. A bridge does not collapse at the first visible flaw. It collapses after enough people have grown used to the flaws and then one final connection gives way. Markets behave the same way. The public sees the crack and says, well, it is still standing. That statement becomes the basis for more optimism, more leverage, more complacency, and more disbelief in the eventual break. Then the final connection snaps. The collapse feels sudden. The preparation for the collapse was slow. That is why I say the delay is the dangerous part. People mistake delay for proof that the economy is stronger than feared, proof that valuation no longer matters, proof that governments can always spend enough, proof that inflation can always flatter earnings without damaging the foundation underneath. I do not believe any of those things. I believe delay has a cost. The longer overvaluation persists, the more leverage forms around it. The longer consumers finance life with debt, the more violent the pullback can become when they finally stop. The longer labor weakness lags, the more shocking it feels when it finally becomes visible. And the longer the public grows accustomed to the market not crashing, the more painful the crash tends to be when it finally arrives. That is why I do not find comfort in the fact that the market is still standing. I find information in it. The standing tells me what the supports are. It tells me what investors still believe. It tells me where the hidden beams are. And once you know the beams, you no longer need to play the foolish game of predicting the exact date of failure. You only need to judge how expensive the supports are, how much strain is accumulating, and how weak confidence would become if any of those supports started to wobble. That is the adult way to think about a market like this. The childish way is to say, it has not broken yet, so maybe the danger was exaggerated. That sentence has ruined many investors. The wise investor does not measure risk by how calm the crowd looks. He measures risk by what is holding the crowd together. Right now, I see a market held together by deficit support, inflation, flattered nominal earnings, indebted consumers, lagging labor weakness, and a stale belief that policy rescue will always be enough. That is not permanent strength. It is temporary suspension. So what do you do with that knowledge? You stop borrowing the crowd's mood. When the crowd is euphoric, you do not let its calm weaken your discipline. When the crowd becomes numb, you do not mistake numbness for resilience. You study quality. You study liquidity. You ask whether what you own can survive a confidence break. You ask how much of your plan depends on continued optimism. You ask what happens if credit tightens, if consumer weakness becomes visible, if earnings disappoint without inflation being enough to hide the damage. And perhaps most important, you protect your own mind from the laziness of binary thinking. The bull wants a permanent story for why prices should keep rising. The bear wants a theatrical story for why they must crash tomorrow. Reality is more stubborn than both camps. Reality often delays both comfort and punishment, but arithmetic remains patient even while human beings become emotional. That is why understanding the machine matters, not so you can perform for the crowd, not so you can sound prophetic, but so you can remain rational while other people confuse delay with safety. Markets do not crash because the internet finally agrees they are overvalued. They crash because the supports that delayed the correction finally weaken, and the crowd realizes too late that the calm it trusted was borrowed. That is why I am paying attention, not because I know the day, because I know the structure. And when you know the structure, you stop asking why it has not fallen yet. You start asking what is still holding it up, how expensive the support has become, and what kind of damage would follow if one of those supports finally failed. Those are the only questions I trust. The answers do not make me theatrical. They make me sober, and in a market like this, sobriety is worth a great deal more than enthusiasm. There is another psychological error people make in periods like this. They become strangely loyal to the delay itself. They begin to think that because the market survived a series of warning signs, The warning signs must no longer matter. The longer the market delays punishment, the more people begin to believe punishment has somehow been canceled. That is not how weak structures behave. Weak structures often survive long enough to make people foolish before they finally fail. That is why late cycle calm is so misleading. The public sees durability. I often see accumulated stress. That difference matters because accumulated stress changes how markets react. Once the break begins, when leverage is higher, when sentiment is more complacent, and when public faith has been reinforced by repeated delay, the eventual break does not arrive as a neat correction. It arrives as the market suddenly remembering everything it spent months trying not to price. That shock is emotional. It is also mechanical. When confidence is the final support, the break does not need the worst possible event. It only needs an event strong enough to make people doubt the supports they had been taking for granted. Once that doubt enters, leverage changes behavior, liquidity changes behavior, risk tolerance changes behavior. What looked calm turns out to have been fragile. I have watched markets long enough to know that confidence can survive absurdity for a while and then disappear all at once. That is why the word overvalued is not enough by itself. An overvalued market can stay overvalued longer than almost anyone expects. What matters more is how it is being kept there and what kind of strain is accumulating beneath the appearance of calm. That is the habit of mind I trust. Do not stare only at the price. Study the structure underneath the price. Do not ask only whether the market looks calm. Ask what the calm is borrowing from. If you see enough debt, enough valuation excess, enough policy dependence, enough consumer strain, and enough faith in rescue, then the right response is not complacency. It is disciplined caution. I do not find comfort in a market that refuses to correct when the fundamentals are clearly stretched. I find warning. And warning, when understood in time, is far more useful than comfort. Comfort is what makes the crowd hold too long. Warning is what gives disciplined investors a chance to keep judgment while everyone else is still mistaking delay for safety. I would rather lose the illusion early and keep my discipline than lose my discipline first, and discover later that the illusion was all I had. That, in markets, is often the wiser bargain. There is another reason I distrust late. Cycle optimism. People become loyal to whatever has delayed pain for them. If deficits delayed pain, they become believers in endless deficits. If inflation flattered earnings, they become believers in nominal growth that is only half real. If the consumer kept spending by using more credit, they begin treating debt-financed endurance as economic strength. That sort of loyalty is emotionally understandable. It is also how bubbles become more dangerous over time. The public falls in love with a thing that postponed the reckoning. Then the postponement itself becomes the reason the reckoning is larger later. I have seen that pattern too many times to treat it lightly. A delayed break does not mean the bridge healed. It usually means the bridge carried more stress for longer. That matters because stress is cumulative. The extra leverage does not disappear. The false narratives do not disappear. The debt used to keep life looking normal does not disappear. The confidence built on repeated survival does not disappear. Everything that was supposed to reset simply stays in the system longer. That is why I think the public often mistakes duration for durability. A market can endure and still be unsound. A structure can keep standing and still be full of risk. This is why I prefer one hard question over 100 soft ones. If the supports were removed, would the price still make sense? That is the question I ask myself. If you remove the deficits, if you remove the inflation, flattered earnings, if you remove the borrowed consumer resilience, if you remove the policy faith, would the market still deserve these levels? I think the answer is obvious. And once that answer becomes obvious, the market's refusal to crack stops looking comforting and starts looking instructional. It tells you exactly where the borrowed strength is. If you can see that, you do not need to act like a prophet. You only need to stop acting like the crowd. That alone creates enormous advantage in a late cycle market.